For centuries, there's been this one big question for anyone looking to build wealth. Where do you put your money? Do you trust the solid ground under your feet or the shiny metal we pull out of it? Property versus gold. It's a debate that's as old as time, but believe me, it's more important now than ever.
I mean, think about it. Both of these are ancient physical stores of value. But in today's crazy, fast-paced financial world, how do they really stack up? Which one is actually the right home for your money today? Okay, let's really get into it.
All right, first up, round one. We're putting them head-to-head against the biggest, most silent enemy every investor faces: inflation. That sneaky force that just eats away at your money's value over time? So, when prices start climbing, which one of these actually holds up?
Yeah, this is a huge question, right? When everything from your grocery bill to the price at the pump is going up, you absolutely need your investments to keep up with the pace, or even better, to beat it. So let's see what the numbers actually tell us.
Okay, now this table gives us a really fascinating picture. And the answer isn't as simple as, one is just better. It's more nuanced. In a low inflation world, we're talking under 3%, real estate, which we're looking at here through REITs or real estate investment trusts, it does a little better. It even has this kind of sweet spot when inflation is moderate, between 3 and 6%. But, and this is a big but, the whole story flips when inflation gets really hot, over 6%, and real estate's real return actually drops into the negative, while gold actually stays in the green.
And boom, this chart right here really drives that point home. When we zoom in on just those high inflation times, you can see gold's power. Once inflation gets really out of control, like climbing over 8% as you see here, gold doesn't just survive, it takes a clear lead. It becomes the better shield for your purchasing power, no question.
So let's build on that and move to our next round: interest rates. When central banks start messing with the cost of borrowing money, it can totally shake up the investment world. So how do our two heavyweights handle that?
Okay, to really get this, we have to talk about something called real interest rates. Now, this is not the rate you see in the headlines. It's the interest rate you get after you subtract inflation. So, for example, if your bank account is paying you 4%, but inflation is at 5%, your real return is actually negative 1%. You're losing money. And this idea is absolutely critical for an asset like gold, which, as you know, doesn't pay you any interest. When real rates are negative, holding cash means you're losing purchasing power, and suddenly holding gold starts to look a whole lot more attractive. And this quote just nails it. It's not about if rates are going up or down. The real question is why they're changing. Is the central bank raising rates because the economy is booming? Well, that could be great for real estate demand. Or are they raising rates to fight off crazy inflation? That could send investors running for the safety of gold. You see, the context behind the rate change is everything.
Okay, for round three, we're looking at a totally modern twist on this old debate. Because today, it's not just about what you own, it's about how you own it. The ways you can get into both gold and real estate have been completely turned on their head.
The choice you have to make today is totally different. Do you want the satisfaction of actually holding a heavy gold bar in your hand? Or do you want the super easy liquidity of a gold ETF that you can trade just like a stock? Do you want all the headaches and responsibilities of being a landlord? Or do you want the passive income and instant diversification you get from a REIT?
Let's break down these REITs. The pros are pretty compelling. You can get started with just a little bit of money, you can buy and sell them in a second on the stock market, and you're instantly diversified across tons of properties. But on the flip side, their prices can bounce around a lot, you give up all direct control, and yep, they can be super sensitive to those interest rate changes we just talked about.
Now, let's compare that to owning a physical property yourself. Of course, you have total control, you can get some amazing tax breaks, and it's a real tangible thing you can actually see and touch. But the barriers to entry are huge. It takes a ton of cash, it's not liquid at all, it can take months to sell, and you've got the very real, hands-on job of managing the whole thing.
And it's clear investors are jumping on these newer, easier options. Just look at India, a country where physical gold is it's part of the culture. In just 1 year recently, the amount of money in gold ETFs shot up by an unbelievable 95.2%. For a culture so connected to physical gold, that is a massive, massive shift in thinking toward digital access.
And we're seeing the same thing on the real estate side. The total market value for Indian REITs just blew past 98,000 crore rupees. To give you some perspective, this type of investment didn't even exist in India just a few years back. This explosive growth just proves that people are hungry for a simpler, more liquid way to invest in property.
So we've talked theory, and we've talked about all the new ways to invest. But what happens when the rubber meets the road? How have these two actually performed, side by side, in the real world over a long period of time?
Let's check out what a 15-year academic study found out.
This 15-year study from Indonesia gives us such a great real-world look. First, just look at the average returns. Property at 12.95%, gold at 12.44%. It's pretty much a tie, right? But now, and this is the really crucial part, look at the risk column. Property got that return with way less volatility, fewer wild price swings. For an investor, what that means is you got basically the same reward for taking on a whole lot less risk. In other words, property offered a much better risk-adjusted return.
So after all that, where does this leave us? We've seen that sometimes gold is the winner, and other times real estate takes the prize. The truth is, there is no single best asset for everyone. The right move depends completely on you. So let's build a little framework to help you figure it out.
Here is a super simple 3-step checklist. Step 1. Take the temperature of the economy. What's the deal with inflation and real interest rates? Step 2. Figure out your own personal goals. What's most important to you? Easy access to your cash, total control, steady income? And finally, step 3. Choose your vehicle. Based on your goals, does an actual physical asset or a digital one, like an ETF or a REIT, make more sense for you?
And that brings us to the final and maybe the most important point of all. We could sit here and debate gold versus real estate all day long, but maybe, just maybe, we've been asking the wrong question the whole time. Instead of asking which one is better, the much more powerful question is, why am I investing in the first place? Are you looking for stability, growth, income? The answer to that question, that's what will lead you to the right asset and the right strategy for your own future.